Now we're going to look at an example with preferred stock that is not cumulative. So if the preferred stock does not say that it's a cumulative preferred stock, we don't have to pay back previous year's dividends that we haven't declared. So that's only in the case of cumulative preferred stock. In this example, we have non-cumulative preferred stock, and even though we haven't paid dividends for 3 years, we only have to pay 1 year of preferred stock before the leftovers go to the common stockholders. So we have our 10,000 shares times our $100 par times our 8% dividend rate times 1 year. And that amount is $80,000. So of our $120,000 stock dividend, after we take out the $80,000 we have to pay to our preferred stockholders, we have $40,000 left for our common shareholders. That $40,000 gets divided by 100,000 shares, and our stockholders receive that amount per share, which would be 40 cents. They receive 40 cents per share for their common stockholders. Our corporation's primary sources of corporate equity come from preferred stock if the corporation has it. Not all corporations have preferred stock. Then our common stock, we have the par value of our common stock and any additional paid-in capital we receive from that sale. And then we have our retained earnings, which is we've worked with before, our accumulated earnings from previous years minus any dividends that we have paid out. Now we're going to talk about some of the issues with common stock. So our common stock book value. This is the amount of the net assets represented by each share of stock. So this equals our total assets minus our total liabilities. That gives us our book value, which is our total stockholders' equity, divided by the number of shares outstanding. Now this assumes that we only have common stock. If we have more than common stock, then this calculation is going to be different. We normally only calculate the book value for common stock. If we have preferred stock outstanding, then we have 2 steps to figure out what the book value of our common stock is. That is that the amount assigned to preferred stock and any dividends in arrears are deducted from our total stockholders' equity. Then our remaining amount of stockholders' equity is divided by the number of common shares outstanding, and that gives us our book value per common share. So in this example, we have preferred stock, common stock, additional paid-in capital of common stock, and retained earnings in our total stockholders' equity. We have paid no dividends for the current year. That means we have 1 year of dividends in arrears of $80,000. So all of the equity belongs to common stockholders except for that $1 million in par value from our preferred stock and our $80,000 in dividend arrears. So when we look at this, we remove out the par value of our preferred stock and the amount of dividends in arrears to get the equity of common stockholders. We divide that by the number of shares outstanding, and that tells us that our book value per share of common stock is $26. So this is our book value according to our balance sheet. This does not mean that it's equal to our current market value. So we have an example where we have this stockholders' equity. We have common stock at a $15 par value, and we have additional paid-in capital of $750,000. We have retained earnings of $800,000, and we want to calculate the amount of book value per share for common stock. So the first thing that we have to do is take our 100,000 shares times that $15 par value. That gives us $1.5 million. We add that to our $750,000 and our $800,000. And we divide that entire sum by the 100,000 shares we have outstanding. That gives us a book value of $30.50 per share. Remember what I said, that doesn't reflect the current market value. So one of the important things to note is that when a company sells stock, they only receive the amount of cash for the very first time stock is sold. So the amount reflected in their book is from the very first issuance of that stock. If that stock changes hands on a market sale, so if it, for example, we have this stock, which has a $15 par value, they sold 100,000 shares. If a stockholder that owns 5 shares in that sells that stock to another stockholder at a market value of $30 per share, the original stockholder receives that $30 per share. The corporation does not receive the money of stock trades. They only receive the money from the initial stock sale to the market for the very first time. That money is what is reflected in the stockholders' equity. So this explains why stockholders' equity rarely changes, even though the market value of stock changes on a day-to-day and sometimes hour-to-hour basis. So here we have preferred stock and common stock, and we want to calculate the amount of book value per share of common stock. It tells us that our preferred dividends are cumulative and they're 1 year in arrears. So remember, we have to take into account that we have 2 years of dividends in that preferred stock dividends that we have to remove from the value. So we have 500,000 shares at a $10 value. We have additional paid-in capital of $800,000. We have retained earnings of $1,750,000. So we need to calculate how much is our total stock. So we have $4 million in preferred stock plus $5 million in common stock plus our $800,000 in retained earnings plus $800,000 in additional paid-in capital and $1,750,000 in retained earnings. That gives us total stockholders' equity of $11,550,000. From that $11,550,000, we have to subtract the $4 million in preferred stock and the amount of our dividends in arrears. So we have 40,000 shares times $6, or 6%, which equals $6 on a $100 par value stock. Now we're 1 year in arrears, so we need 1 year of dividends. So we also are going to subtract our $240,000 in preferred stock dividends. That gives us the amount of stockholders' equity that is attributable to common stock. Which is $7,310,000. We divide that amount by our 500,000 shares, and that gives us a book value per share of $14.62. As I said before, after shares of stock have been issued initially, they can be sold from one investor to another. That price is the market price of the stock. The market price of the stock is very different from the par value of the stock, the original issue price, and the current book value of the stock. You can look up the market value of any stock just by simply Googling the name of the company. In a search bar, you can also go to websites like Yahoo Finance and look at current market values of stock. When we issue stock, we record the issue price. This is the amount of cash we receive from the very first sale on the market. These balances remain unchanged in our stockholders' equity unless we issue more shares. So remember, we're authorized to sell so many shares, and then we have our number of shares outstanding. We can sell additional shares at any given time. So the only time our account in our stockholders' equity amount would change is if we either issue more shares or we buy back outstanding shares. When we purchase back outstanding shares, those shares are called treasury stock. That means that the company has purchased them back from the market and they're not outstanding shares. The market price of preferred stock is influenced by a lot of different things. One of those is the dividend rate. So how much the company pays in dividends. People who purchase stock want to earn money on stock. There's also the risk of the investment based on financial and economic factors. So that risk depends on how well the company is performing or how well the economy is performing. If you've been watching the news right now, the economy is not doing so great because of all of the unknown impact of people being shut in their houses as we are right now due to the current coronavirus pandemic. So when interest rates rise, preferred stock prices decline, and when interest rates fall, preferred stock prices rise. One of this is because if interest rates are rising, that means in the market I can make more money on bond investments because the market interest rates are high than I can on preferred stock with an interest rate of 5 or 6%. However, if the market interest rate is really low, I'm more inclined to get preferred stock than I am to purchase bonds because I'm going to make more money on interest rates from the preferred stock than I am going to on bond sales. We're going to talk more about the influences of market price on how stock market prices are determined in Chapter 12. So another factor of a market price for common stock is what we expect the future profitability of the business to be. So if the company is really successful, then the market price of the stock can increase dramatically. If a company is not successful, then stockholders might not even recover their original investment. So what might happen is we might have had a sale price of $25 of stock. So that's how much I paid for my investment. For example, I could have bought a piece of Amazon stock and paid $25 a share for it. And then if we look at the market price of Amazon stock, the last time I checked the market price of Amazon stock, it was selling for around $1,500 a share. Well, I just looked it up and it is at $1,900 a share. So that means that if I would sell stock, I would have a capital gain between that $25 initial investment and what it's currently be trading for at $1,900. Now, I could have spent $25 in a stock for a company that is not being successful right now. And that stock might have dropped in price to $2. That means that if I sell my stock now, I'm going to experience a loss because the current market value of the stock is $2. Book value is based on the amounts earned and retained by the corporation. Market price is based on the future potential value of a company. We want our market price to be higher than our book value. If it is less than book value, that means that we don't value how this company is going, or that the market doesn't value what this company is currently doing. The different financial analysis that we do on stockholders, we have return on total assets, which is our net income divided by average total assets. And we also have our return on common stockholders' equity, which is net income divided by average common stockholders' equity. We're going to talk about a few other financial analysis and decision-making ratios in relation to stock in Chapter 12.